Hello, and it's actually been a while since the first episode of the basic concept, but here we are again. So, welcome episode 2, and episode 2 is about the why the markets move. Sorry, not for the perfect English sentences, but we are trying to get what is all this. So from the first episode, I did a little introduction, and now yes, I'll try to explain maybe at the start very easy concepts. So why the markets move, it's a fundamental thing to know. Why is all this? What are these candles? Everything, and then we will move on to more important concepts. We also move on about the little technical things like some apps to use, what are the charting platforms, what are the brokers, prop firms, all of that I'm sure many of you that are watching the video know. But if you don't know, you'll stick around for the next few videos. You will see a lot that I will wear this hoodie because now I'm gonna record maybe 3 or 4 videos, so you'll see the time going by like here. And so yeah, so I'm just gonna play around with the chart. I'm gonna explain why the markets move. So what am I doing? Like, what is all of this? The candles, what is a candle, everything. We are watching mainly the futures markets. So the futures markets, what we trade, there is also Forex, there is also commodities. So you can also trade gold, you can use also the dollar index. There are many things you can trade. For the sake of the thing I'm doing now and for what I'm actually doing, I will explain better futures. So futures, we have contracts, different type of contracts. In this case, the most famous indices. So indices, Nasdaq is a collection. Top Nasdaq 100. Nasdaq is the top 100 firms in America that are collected inside. ES is the S&P 500, so the 500 Fortune company, and Dow is the 30, a collection of 30. So these are the main indices that I watch on a daily basis and that actually behave kind of similarly to each other. And you have to spot the differences and the similarities to your analysis to enter in your operation and trades. In this case, we are using micro contracts, so 10 times less than a normal contract. A normal contract will be in just ES or just NQ. Why we trade micro contract? Because it's easier, especially at the start, to manage your positions and everything. But I'll have a dedicated video on positioning, on different strategies, and what strategy I use and my sizing and everything and the risk. In this video though, as I said at the start, we're going to speak of why markets move. So markets move for different reasons. Markets move, of course, depending on the performances of these firms. Okay, so how are they doing, the earnings, revenues, everything, all the other data you can find on Yahoo Finance or whenever you can see. So some companies have a larger portion of influence on the indices, so there are a collection of many other firms. And so sometimes when there are like news, so reports on earnings or quarterly earnings, whatever, or maybe other news important on CEO, or maybe a new process that it's found or whatever, or controversies. Yeah, you got it, what I was saying. The stock of the firm can move, but it can also move the indices. Not maybe alone, so maybe different industries. Like a few days ago, healthcare was moving a lot, while banks were not moving that much. So the indices were not like moving super up like the healthcare was moving, or moving super down like the banks were doing. So yeah, this is a simple thing that they go up or down. It can also be political events. So when also Trump got elected, we rallied before to all-time highs. So here Trump got elected around here, and their inauguration, then we dumped especially for the trade war, for the tariffs. So for the tariffs thing and tariff talks, we absolutely ripped to the downside. So you can see that also main headlines and news of the political economical world can influence how the markets move. Okay, so Trump spoke, boom, then trade talks were made and trade agreements were made. We came back up. So that was actually, I also said to my girlfriend when we were right about here, oh, it's a good time to buy. I actually didn't buy more. We did end up moving quite a lot, like 30%, yeah, almost 30%. But you can also buy spot positions or to invest. In this case, we're buy intraday contracts, micro contracts. Keep this in mind for future videos. So the markets move for these main reasons. Also, of course, macroeconomic factors. So interest rates, the American debt, but can also move depending on different markets, the European markets, the Asian markets, Japan, China, Russia, whatever. They all influence a bit how wars can influence a lot the price action of these markets. So I just gave some random thoughts of why the markets move. So the firms, political headlines, news, economic news, wars, and what's happening and at the macroeconomic scale. So these are the main reasons that markets move. But if you want to do this, and if you believe that there is kind of an algorithm controlling these indices, markets move also depending on different kinds of reasons. So to fill inefficiencies, in this case, we have gaps in price. You can see here we have a gap here. We have a gap here. So markets sometimes tend to gravitate around the points, the inefficiencies. Inefficiencies can be in this, that can be consequently tapped in. So like here, as you see, there was a gap, we filled it, then we went back to it. Also here, there was this gap, we came back almost to fill completely. So filling this gap, it means that price tried to cover this space, okay? In this case, we didn't. So we are seeing maybe in the future, the price will tend to look to fill these gaps. So as I remark it again, and this is called a new week opening gap. We also have 4-hour gaps, which are very important. I don't want to enter too much on the inefficiencies, but we can also aim for inefficiencies. We can also aim for PD arrays. So all the institutional tools that also banks can use. So institutional order flow, order blocks, so many things that we'll talk about more in detail because this goes more into strategy. But we care that the markets also move to fill inefficiencies. Market move also to target liquidity. Liquidity is basically the highs and lows that price makes. This highs and low could be lower time frame, so it can be on the 1 minute, 5 minute, 4 minute, 15 hourly, and also could be on the higher time frame, so it could be 4 hour, daily highs and lows are very important, are very useful. So price many times tend to gravitate towards these key points, key areas, and you have to look out for it. And then what I have in mind, there are so many things, so many thoughts, and so many opinions on this topic, but that's for me the main reasons why the markets move. You can also check online resources to fact check all this thinking, but there are still a lot of other opinions. So in this case, we talk about inefficiency and liquidity. I will do a dedicated video on liquidity because it is very, very, very important and is for me the main driver of the markets. So in order that the markets to move, we need to have liquidity. So basically it's cash moving, so order stops getting filled, so people are actually losing money because the market doesn't want you to win, but it will always seek stop losses of traders, of retail, or whatever. And so we have to be very, very careful with that. And for the future, we need to be very careful with that. So yeah, I yapped a bit as usual. In the future videos, I hope to do many of them. Will be more focused on some little topics and go more in depth with that. But here for me were the main reasons why the markets move. I hope you enjoyed this video, and I'll see you in the next one.